thoughts about the Tesla earnings call, which is coming up tomorrow. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. Tesla is our largest position, so obviously we're thinking deeply about the company on a daily basis. And earnings calls are really, it's the kind of check mark that investors have to feel the pulse, to see what's going on. The company opens up, talks about what's going on in the business. And with Tesla, actually, that's pretty good. I mean, often these calls can be very scripted and boring. With Tesla, typically it's not. You learn a lot, and there's a lot of interesting thoughts. And the purpose of this particular episode is to give an overview over how we think about this. It's not necessarily the questions we have or things like that. It's more in general how we think about the call, what we expect, how we're going to calibrate the call relative to our expectations. And then we're going to do a post-earnings analysis. We're going to try to explain where we see the company and how the company's message relates to our thoughts, which is the most important thing as an investor. And just let me remind listeners, maybe newer listeners to this podcast series, the purpose of the podcast is to give people a sense for what it feels like to run a hedge fund. So when you have a large position like we have in Tesla, the most important thing is that you're in tune with the position. And if you're not in tune, you have to start thinking about positioning, maybe reduce the position, things along those lines. As long as you're in tune, let me rephrase that. As long as you're in tune with the position, then the problem is only the sizing and leverage and portfolio management. But when you're not in tune, then you have to start thinking about the position. So this is really important. These calls are meant to give you that sense. And that's what we're going to do now in this call, try to, preamble kind of what's coming, how we feel about tomorrow. And then we'll do a podcast where we're going to discuss what we thought in advance and how it actually pans out. This is the Not Even Wrong podcast. It's January 24th, 2023. This is Krim Delco. For the day, the fund's up 80 basis points. The market was down 20 basis points. For the year, we're up 18.6%. The market is up 4.6%. We're outperforming by 14%. The outperformance this year has been driven by Tesla. And let's just jump right into it. What happened with Tesla in the last couple of weeks, in our view, is incredibly important. We actually increased our position about a week ago for exactly that reason. What happened is that, in a nutshell, Tesla is the cost leader in luxury autonomous electric cars, which in fact we believe will be soon the cars. In other words, all this niche stuff, electric cars, autonomous cars, luxury cars, you can wrap that all up and say this is going to be the car of tomorrow. So basically, Tesla is going to dominate the market for cars, for transportation in general. And therefore, we believe that will happen because Tesla is the cost leader. So it's not going to happen because people like electric cars for environmental reasons or the design, or they like Elon Musk or any of that stuff. These are all factors, particularly the design. I think we should do a podcast episode just about design, just about the how should I say, the impact that, let's say, Franz von Holthausen, the chief designer of Tesla, has on the perception of the brand and how it transpires into perception of transportation and cars. I mean, just one little side note here, just for me as an urban person to want to buy the Cybertruck, that's a design thing. So, but let's get back on point here. So again, the reason people will adopt cars and Tesla will become the market leader with a very large market share is because they're the cost leader. The cost structure of a company defines the company. A disruptor is defined by the cost structure. The reason disruptors succeed is because they have a superior cost structure. That's why incumbents can't respond. This is very important, and I am working conceptually on an essay about that because I want to expand Clayton Christensen's disruption argument that he wrote, that he laid down in The Innovator's Dilemma, about 25 years ago, when he specifically said that disruption is driven by companies that come up with products and services that are either new or attack the low end of a market. And then they creep into the high end and disrupt incumbents. And incumbents, they don't care because they don't see it. They don't see the threat until it's too late. And it's my argument here that this is not true. This is, in fact, we believe that the reason incumbents don't respond is because they can't adjust the cost structure. Cost structures are sticky. Cost structures are very difficult to change to the down. And that's what the essay is going to be about. It's thinking a little bit more deeply about, is that really true, and why is that? My intuition is telling me it's because humans are just not very good at lowering their standards of living, and companies are just made out of humans. So lowering the cost structure means you have to kind of be able to reduce your standard of living. Now, that has, of course, a couple of facets. For example, the low-hanging fruit is things like, okay, fine, look, if you compete with a very aggressive competitor, you might want to, let's say, reduce business class travel, or you might want to tell your employees to not work from home, come to the office, so you have more efficiency. Those are the low-hanging fruits, but cost structure is a lot more than just people working a little bit harder. Cost structures are things like, for example, well, you can do things in a certain way, okay? Or you can do things in a different way. And what I mean with that is, let's say in company A, which has a higher cost structure, people just buy components and then they hire other people to put them together. And they, let's say the company, the OEM, just sees itself more as a sort of brand, marketing, financing arm, which is kind of what the automotive industry has become. Versus a company like Tesla or Disruptor is more kind of like the, roll up your sleeve type company where, well, we can solve this problem ourselves. How about we just buy basic materials and put the stuff together in the garage, and then it's the same effect, but it's 10 times cheaper. And this one component saves us maybe, only 0.5%, but it adds up. And if we can add up stuff, then we end up having a better cost structure. I recently listened to a podcast, an interesting podcast about a company, very different. It's a company that does Bitcoin mining in West Texas with a flaring business. In other words, it takes flared gas, uses that for Bitcoin mining. And what's interesting about that company is they do everything themselves. And the founders of the company, they actually spoke about this, and they said how they have a cost advantage and how they are just better at doing what they do because they do everything themselves. Vertical integration. So I think vertical integration has a lot to do with the cost structure. So why am I talking so much about cost structure? Because what happened in the last couple of weeks is that Tesla has been a cost leader. What happened in the last couple of years is the following. Tesla has been creeping up into the market as a cost leader. And then the inflation, the pandemic-induced inflation hit, which is a whole different macroeconomic issue, but inflation hit. It happened. And it happened in the grocery store as much as it also happened on the sort of employee front. And that hurt Tesla as much as any other company, because not necessarily just because of Tesla, but because of the supply chain. And when that happened, they started raising prices. And when they started raising prices, their cost leadership started getting blurred. Yes, Tesla was still the cost leader, but it manifested itself not in higher market share, but in higher margins. And what Tesla now did a few weeks ago is change the course again to say, well, we're going to keep our margins relatively high, but we're going to lower our margins, so we're going to go for market share. And this is why we started buying Tesla stock again, because this is unbelievably important. Tesla is a market share story. Like I said, we expect Tesla in a couple of years, maybe 5 years, maybe less, to dominate the market. We expect an Apple-type market share of like maybe 30% of volume, but 80, 90% of value in the transportation market, anything which has to do with transport. And that starts with, the typical sort of car, that families use to do stuff, all the way up to semis and in between, the trucks and all that stuff. All of that value, the trillions of dollars of value, will be captured by Tesla, not because it's some sort of environmental mandate or whatever, none of that, or the next president is going to be friends with Musk. It's simply because they're going to be the cost leader in cars, in autonomy, in batteries, in energy. We have a section on our website about regenerative growth, which is growth that, by consumption you get better at, the product gets better, which is kind of the fundamental premise of AI, if you will. So all of these things together will drive Tesla to be a cost leader going forward, and they will gain market share, and they will dominate the market. That's our thesis. Is it going to be like the sort of Apple Samsung market? That's not clear, but it's something along those lines. So that's what happened in the last couple of weeks. And this is where we stand today. So what are we thinking about the call? Well, we want to make sure that thesis is correct. This is the most important thing. Are they a cost leader? Are they going to maximize market share? Are they going to keep some sort of decent margin, which means something in the mid-20s? We think that they can do automotive margin in the mid-20s. I don't think they will talk about it too much tomorrow, because they also have an investor day coming up on March 1st. So they will talk about that more. But we believe that by 2023, by the end of 2023, the automotive gross margin for the year 2023 will be in the mid-20s. This is a belief. It could be revoked tomorrow. Maybe Zach Corcoran will say something else. But that's what we believe. Very important. So this is definitely one very important point. Another thing that we want to hear tomorrow, or something we expect to happen, is that the Semi and the Cybertruck launch is continuing. Today there was news that there will be a big factory built in Nevada for the Semi, which is great. So we want to hear traction on those fronts. We want to hear traction. And I think what's also important is we want to hear traction on several engineering/software fronts. So for example, it would be good to hear some maybe tidbits of how engineering in the Semi is helping drive the Semi, because the Semi, according to Bill Gates, defies the laws of physics. Now, of course, it doesn't defy the laws of physics. The only thing it defies is the laws of engineering, or the knowledge of engineering that we have today. But that's exactly the point. Tesla is continuously evolving engineering practices, and therefore able to deliver, something like a Semi, which is a completely new concept. So it's again, it would be nice to hear some. This is a nice to have. Okay, it's not necessarily an earnings call thing, but just hear some engineering advances. The 4680. So there's a couple of technological steps that we hope they can do this year. One is, advance the 4680 to mass production in the consumer-facing cars, Model Y, Model 3, and so on and so forth. Then we have technological innovations around the Semi and technological innovations around the Cybertruck. Of course, the Cybertruck launch and starting to sell it in volume, maybe some sort of volume guidance. That would be great. Talking about volume guidance, another thing we would like to hear, of course, is reiterating the volume guidance. We believe they can do up to 2 million cars this year. That's what we believe. Let's see where they stand with the guidance. They might have caveated with macroeconomic headwinds and so on and so forth. But that's kind of the big picture. So to summarize, what we really want to hear tomorrow is, first and foremost, that they are committed to being a cost leader, that they can do it and that they're committed to it, and that they will therefore grow volume with a decent margin. Again, mid-20s would be great if they can commit to it. Let's see where that stands. But they don't have to. I mean, it's obviously the macro environment is volatile. So it's going to be a little bit more difficult to maybe give clear guidance, and maybe they shouldn't. I mean, that we're not too crazy about that. So put the margin guidance aside. We want volume growth at a decent sort of industry-leading margin. That's kind of where the phrasing has been with Tesla. Let's leave it at that. We want to hear tidbits or engineering advances in several product lines because that is going to drive not just the cost structure, but also demand. And that's really what Tesla is all about. And hopefully we can hear also maybe a couple of clarifications about Elon Musk that would help. It's not something we're too concerned about, but it would help if Musk would give us a little more guidance of how he stands with Tesla and Twitter and how that works. That would be good. And I think finally, really last but not least, but if they could talk a little bit about the situation in China, the way they see China unfolding as a market, the way they see China unfolding also as a, let's say, is there going to be a China design car, for example? I mean, Franz von Holthausen recently said that that's not the case yet, but maybe give us a little bit more meat around the bone of what's going on in China in terms of the market and what we should expect going forward. Thank you.